I'll call to order the Santa Barbara City Council Finance Committee meeting for July 25th, 2017. Is there anyone who would like to speak to any items that are not on the agenda? Seeing no one, we will go to the regularly scheduled items, which is the quarterly investment report. Ms. Nemes?
Good afternoon, Chair Hart, committee members. I am Julie Nemes, Treasury Manager for the City Finance Department. Today, I will be presenting the quarterly investment report for the quarter ended June 30, 2017. I will be going over 5 different areas similar to every other quarter. First, I'll be covering the interest rate environment. Second, I'll be going over the city's investment strategy and approach. Third, I'll be covering some long-term trends. Fourth, I'll be covering some benchmarks, comparing some of the city's activity for the quarter versus some benchmarks. And last will be the performance and activity for the quarter. So first, a little information on the interest rate environment. You may recall back in December 2015, the Federal Reserve increased the interest rate by 0.25%. That was the first time in 7 years that they had taken action to increase the interest rates. Since then, they've done it 3 more times. Once in December 2016, again in March 2017, and just recently again in June 2017, each time by 0.25%. They also hinted in June that there may be one more increase by the end of the calendar year, but it will all depend on how the economy is doing. The Federal Reserve did give several reasons for this increase in June. A lot of them are similar to what they stated back in March when they increased. First, the chair did actually say she felt that the economy was increasing at a slow and steady pace. They had confidence in future economic growth, and they felt that that would lead to potential future increases as well. The unemployment rate is the lowest it has been in over a decade, since 2001 actually. It's down to 4.3%. They believe they are reaching full employment, maximum employment. Third, the labor market is strengthening. It's been 80 months straight that jobs have been added to the market. And inflation is the one area that they were a little unsure of. Inflation in January was at 1.9%, and the Fed has a target of 2% to raise interest rates. It has dropped from 1.9% to 1.4%. However, the Federal Reserve thinks there are one-time impacts. They believe that discounts on pharmacy prescription prices might be impacting that. Discounts on cell phone service charges might be impacting inflation. So they didn't want to be alarmed by it at this point. They feel like there could be just a one-time or a couple one-time impacts causing it to fall from 1.9 to 1.4, and that they'll see how it inflation reacts over the next couple months. A little more information on interest rate environment. We continue to see Treasury rates remain pretty steady. They're still significantly lower than they were prior to the recession. At June 30, the interest rates are similar to what they were at March 31st. The short terms continue to show the largest increases. We've seen that for several quarters. The LAIF rate, 3-month, 6-month rates, those tend to have the larger increases. The longest term treasuries slightly decreased from the last quarter, and that was the 5, 10, and 30. I have a chart in about a couple more slides that will present that information. As I mentioned, the Federal Reserve is hinting at one additional interest rate increase, but it will all depend on how the economy does. And I did want to point out that while higher rates impact Treasury yields, increasing rates also allows the Fed to cut those rates in times of where the economy, they need to stimulate the economy. So it gives them a little bit of a buffer in the future. So what have we seen since June? It's just been a little time since they did the last interest rate increase. There's been factors that we've seen that both support and don't support the position to raise interest rates. We continue to see this lower inflation in recent months. We don't know yet if it's if they're one-time impacts or it's a short-term drop or if it's going to continue to be well below that 2%. Unemployment continues to drop. It's dropped every couple months for the last year. We are nearing that maximum employment. As we reach maximum employment, there is going to start to be pressure on wages. As there's less people available for jobs, it'll put pressure on wages to increase, which then can impact inflation. We continue to see a lot of global uncertainty in China, in Europe. There are still a lot of banks in Europe and Asia that are offering negative interest rates. It all has an impact on global demand for our foreign products, and we see how a lot of the uncertainty with what's going on with presidential policies is also potentially impacting foreign demand. And as I just mentioned a minute ago, presidential policies, we do see them impact Treasury yields when the Senate takes action or doesn't take action. When there's presidential policies that are put out there, we do see impacts on the daily Treasury yields. And I also wanted to mention that some of these things we're seeing, they might just be temporary, and the market sometimes responds quickly and bounces back up a couple days later. But I did want to mention these are some of the things we've seen over the last 30, 60 days. And even though rates are slightly higher, they're higher than they were a year ago, it still does take several years before the city sees a material impact on the interest income. The interest rate is up for the city, the portfolio rate, but it takes a lot of time as investments mature or are called as we reinvest into the market to see a significant impact. This is the chart I referred to a little while ago that shows all of the different rates from 3/31 all the way through 6/30. And you'll notice the lower to the shorter term are the ones that saw the largest growth. The 3-month had a 27 basis point growth, whereas the 30-year saw the biggest decline at 18 points down. The mid-range is generally where we invest, the 1 to 5 year, and that the rates at 6/30 for 1 to 5 year range from 1.24 to 1.89. And all of them saw increases or were level except for the 5 year, which actually did see a decline of about 4 basis points. I wanted to point out one thing. I'll go back for a second. The LAIF rate, which is we invest with the state, we continue to see that perform very well. It continues to increase every quarter. It's now at 0.92%. I believe I have a Treasury yield from yesterday. I'll show you in a few minutes. I think it might even be at 1% now. So it continues to perform very well. I just wanted to point that out. So moving on to the city's investment strategy and approach. This should all be very familiar, but our primary objectives are safety first, then liquidity, and then yield. Preservation of principal is our primary goal. Then we look to meet the liquidity needs of the city, and then we look to earn a fair rate of return. Our investment approach is to buy into the market. We don't chase yields. We don't try to predict what the market will do. We attempt to maintain a steady maturity ladder over a 5-year period. This is really important, especially when we have large projects, and make sure that we have the funds necessary to do any large projects. It ensures we have adequate liquidity at all times. It also prevents us from investing too heavily in a bad interest rate environment. This first chart, first graph it's a comparison to our benchmarks. It's the portfolio rate versus the 2-year Treasury, the 5-year Treasury, and the LAIF rate. We show this every quarter. It really shows how much interest rates have been impacted with the recession. They dropped significantly after fiscal year 2007, 2008. They are picking up. You'll notice from fiscal year 16 to 17, all of the rates have started picking up again, gone up about 1 percentage point on average. Generally, this is a good benchmark because it shows the city's portfolio rate should go along with the 5-year, the 2-year. If there's a big deviation, it would cause some concern. We'd want to look into it. If the portfolio rate was doing substantially better than any of those rates, we'd want to question whether we were being too risky. There is always a time lag. You'll notice that the portfolio rate will fall slower than the other rates or rise slower than the other rates, and that's because it takes time as things are called and matured for us to get back into the market. As of June 30, the city is below the 5-year and just about even with the 2-year, about 1 basis point below the 2-year, and that's due to the recent rise of all the rates. But as we invest more, we'll pick up a little bit on the city's portfolio rate. And the other reason for that is we are holding a lot of cash right now. So when we hold more cash, we have it in our checking account and the LAIF with the state, and both of those are below the 2-year and the 5-year, and that will pull our portfolio rate down. And in a couple slides, I'll go into why we are holding so much cash right now. This is what I mentioned a few slides ago. I wanted to show you the Treasury yield as of yesterday. I always like to present this slide because it gives you an idea if we were to invest today, what could we get for all of our 1 to 5 Treasuries. And you'll notice that the 1 to 5 is about 1.22 to 1.82 for the 1 to 5 Treasuries. Also, LAIF is at 1.04 as of yesterday, so it has breached the 1% barrier. The one thing I thought was very strange about this chart, and I looked into it further, is the 3-month has a higher yield than the 6-month. That is very strange. We don't normally see that. A longer term should give us a higher yield. And I wanted to point this out because the reason for that is that currently the 3-month treasuries will mature around the same time that the Treasury is expected to run out of money unless Congress boosts the limit on federal borrowing. So there's a slight risk that they're giving to the 3-month, which boosts the yield. And that will change pretty quickly once they disarm the Treasury, the federal government boosts that limit. But I did want to point out all of the rates from 1 to 5 years are lower than 630 as of yesterday, but the LAIF and the 3-month have both increased. So we are continuing to see that trend where the shorter terms show the largest growth and the longer terms don't show the same growth. Moving on to the performance for the quarter for our portfolio, we saw the yield go up. It went from 1.337 at March 31st to 1.372% at 6/30. Our interest earned for the quarter increased to $589,000, which is about $83,000 more than last quarter. The general fund portion is $164,000. I did want to mention, I just looked at the year as a whole, and in total, our interest for FY17 was $1.9 million, but the budget was $1.67. So we did exceed our budget, and a lot of that was just due to rates being higher and being able to invest into better yields. And so we had about a $224,000 earnings above budget. And total portfolio is up about $18 million over the last quarter. We have $187 million in cash and investments at 6/30. It is a very large balance. It's bigger than we normally have. We had quite a bit in SRF, State Revolving Loan Fund, reimbursements come in the last quarter, both from water and wastewater. That boosted our balance. Also, this time of year, we always see a larger balance because it's when our last property tax payments come in. So we expect to see from 3rd quarter to 6th quarter to see it go up, but it went up more substantially due to reimbursements. So the next couple slides will actually be information both on the activity and a snapshot of the portfolio. This first one is the activity. In the last quarter, we purchased $8 million in callable securities. They are securities that have a call feature that can be called by the owner. We also purchased $8 million in what we call bullet securities. They do not have a call feature, so they go all the way to the term, to the maturity date. Those replaced $6 million in federal agency securities that did have a call feature and that were called, and also $2 million in federal agency securities that actually matured, so they went all the way to the maturity date, as well as $149,000 in a semi-annual principal payment on the airport promissory note. In total, $7.85 million was taken out of our account to make investment purchases. I did just want to note that sometimes this comes up, so I wanted to provide you with the information that the airport note does have a current balance of $4.48 million. Moving on to the snapshot, whereas the other one was activity for the quarter, this is really just a picture of what is in our portfolio at 6/30. So as I mentioned, we have about $187 million in the portfolio. This is a breakdown of all the different types of investments we have. The first two are what we call our liquid balance. It's the checking account and our LAIF balance. We have about $78 million in LAIF and checking, which is a very high balance. I'll go into that in a moment, why that's the case. Compared to 3/31, we have $10 million more in our liquid balance. We also have about $8 million more in the federal agency issues line. You'll see the $85 million. That has increased $8 million due to the purchases we made this quarter. That's what makes the difference between 6/30 and 3/31. Now I can give you some more information about why we're holding so much cash. So for fiscal year 18, CalPERS, we normally make monthly contributions to CalPERS for the 3 retirement plans, police, fire, and miscellaneous. They have offered to us for the first time to make a prepayment on part of those contributions. The monthly amounts to $18.4 million, but if we prepay it, we pay $17.7 million. It's a savings of $650,000. Is a discount they're providing to us if we pay the 1 year in July versus every month for the fiscal year. So we did some analysis and we looked at, well, can we earn more interest than what we would receive on the discount? And it's not close. Even if we looked at putting it in a 5-year note, which wouldn't make the cash available for us to make the monthly payments, but we would look all the way out, that would only get us about $350,000 in earnings. So the discount of $650,000 was definitely worth it. It kept more money at the city. So we are prepaying that actually this week. So we needed to keep $18 million in LAIF, which we can draw the same day. And we've already drawn $18 million of that from LAIF yesterday and today to make that payment. So that's why that balance is so high.
Is that a cashier's check?
No. It's what we call like an ACH draw. This is the same information I just provided, but in a chart, a graphical representation. So you'll notice that most of our money is in agency securities, about 46%. We also have 5% in corporates. We have 5 different corporates. We have the 2% note, 1% in treasuries, 4% in CDs, and the remainder is what we call our cash, our liquid balance, the 7% in the checking account and the 35% in LAIF. Once we make that $17.7 million payment to CalPERS, that will drop to 36%, which is more in line with generally how much cash we keep. We also have, it's still a little bit high, we have about $10 to $15 million also in our LAIF balance for any desal costs through summer. And once that is, all of that is complete and finished being paid, we will reduce that LAIF balance. We generally keep $30 to $45 million in LAIF. And that brings me to our request of our recommended action that Finance Committee recommended Council to accept and approve the fourth quarter investment report. And I can answer any questions you may have.
Are there any questions for Ms. Nemes? Councilmember Dominguez?
So the total amount of cash and investments is $186 million. And I was thinking about that in terms of how that relates to our budget and our reserves. So I know our general fund budget, and this is general fund and enterprise fund, cash and investments, but I know compared to our budget, it's much bigger than our budget. So is this the ballpark figure we normally have at the end of the year?
Councilmember Dominguez, so this does represent all of the cash investments for the city as a whole. It's all funds. Mm-hmm. This is higher than what I've seen. I know Mr. Samario mentioned this is a higher balance than what he normally sees. As our reserves go up and as revenues go up and our budget goes up, I would expect to see our cash balance go up. We recently received some rather large reimbursements on SRF loans, and that boosted the balance. But last year at this time, I believe we were in the 160s. So it is about $20 million higher than it was last year. We were a lot lower last year than we normally were, but we generally, in the last couple of years that I've seen, we're generally in the 160 to 170 range at this time of year.
So since I've taken office?
It might be the same time range.
Pure coincidence. And then related to reserve, so are these considered part of our reserve? Are these the same book of funds, or is it a separate?
This is purely just the cash on hand that we have. The reserves are a different calculation, and our reserves are just our general fund reserves. This is the cash for every single fund.
So some of these investments, let's just say a disaster struck and we couldn't redeem some of these investments. We still have a reserve that's independent of this cash, or this is? No,
the reserves are in a portion of this. That's correct.
What percentage of our reserves are invested in these various instruments? Is it proportional to the slide on 13?
So we pull, what we do is it's a pool. So we take all of our cash for the city as a whole, and we bring it into a pool, and we invest it all together. So there isn't a portion that is allocated to the general fund or to an enterprise fund. It's the pool in general. It's the city as a whole.
Okay.
Maybe.
Yeah, just to clarify a little bit. So the cash is one asset in all of the funds that make up most of what we measure as reserves, but it's a different calculation. So reserves is really the difference between all the assets we have and any liabilities against those assets or any claims against those assets. So, for example, if the general fund had $10 million in cash and $2 million in other receivables, they have $12 million in assets, but they might have $5 million in liabilities. So the difference between those two is what we measure as reserves. So that difference is made up primarily, proportionally, mostly of cash, which we invest in the same proportions just for the entire organization, but it's got other components to it. So I wouldn't say the reserves is represented by our cash. It's a component of it, the primary component, but it's not. They're not equal, because we don't have $186 million in reserves, because you'd have to reduce it by any liabilities against those assets. Does that make sense?
Assuming you planned on paying the liability, or
Well, we do, of course.
right?
Yeah.
And is that because is that the difference between an accrual and cash based, or is there reserves an accrual
Yes.
budgetary construct?
Yeah, we don't account for our activities on a cash basis. We do accrual, or what's called modified accrual for our governmental funds, but we still include on a balance sheet, for example, all the assets we have: cash, receivables, and for enterprise funds, fixed assets like equipment and infrastructure, and then we also include debt. So typically, liabilities related to just our typical vendor payments, also for vendors for large projects. We have liabilities related to bonds that are outstanding or loans that are outstanding. All those really reduced then, on a net basis, our total assets, or claims at least against our assets. The difference of those two is what we measure as reserves.
Okay. And going to the CalPERS information, and that prepayment is for all categories of CalPERS, public safety, general, et cetera?
That is correct. It's
Okay.
all three of our plans.
And so 18 million is fiscal year 18's line item.
Correct.
Okay. Great. Thank you very much.
Councilmember White?
Thank you, Mr. Chair. I want to follow up a little bit on that too. What are they doing? What's the purpose of that discount?
Yeah, good question, Committee Member White. So what they do is, so you got to back up and recognize that they assume that whatever money we give them, they're going to invest and earn 7.5% today. It's going to be lowered over time, but as they're reducing the discount rate. But they're right now targeting their investments to get a return of 7.5%. What they tell us is, if you were to prepay that money in July versus throughout the year, we will give you credit equal to approximately 6% of that. So is the reason why we could only earn a couple $100,000 on those monies if we kept it versus what they're going to give us is because they invest in things we can't. We would earn 1 or 2%. They're going to hopefully earn 7.5%. They give us 6% credit for that, and so they're kind of assuming and banking on the difference that they can earn above 6%, and that just kind of goes towards the overall assets that they have. So it's a little bit of playing the arbitrage. But they're going to take that money and they're going to apply it to our employees and to our employer portion of all the normal costs and unfunded liabilities. They're just giving us a little bit of a benefit by prepaying it because they know they can earn more than 6%, but they're giving us credit for 6%, and we know we're not going to be able to earn nearly 6%. So it's a little bit of helping to improve our budgetary situation. Does that help?
Maybe it's a fatuous question too, but I wonder about how they have the ability to invest at a higher rate in different instruments than we do, and I appreciate that point. And I heard on the radio, so whatever that's worth, that they actually earned more than their stated
They did.
7.5% this last year. It was the first time in several years that they had actually exceeded their target this last year. I believe it was in the 13% range or something.
I think it was like 10.2.
Okay, well, you would certainly have a better feel. No, okay, thank you, Mr. Chair. Just curiosity.
Any other questions? Councilmember Dominguez?
Yeah, just to follow up on that. So they're basically betting that they can make more than 6%. So let's say they only make 3%, the market stays really flat. So they're going to be kind of in the hole a little bit, or their liabilities will increase relative to what they need. So are we going to end up covering that bet anyways, or at least maybe then it's spread over the entire
Yes.
state?
Yes, that is absolutely true. It helps us this year from a budgetary perspective because it saves us about $600,000, which is a lot of money. Yeah, ultimately it's going to come down to us because if they earn 3%, like you said, that's part of their actuarial losses. Then we're going to have to make it up in the future through nominal increases to rates. But because we're prepaying it versus if we're going to pay it anyway, that same $18 million, they're giving us a bit of a credit and a bit of a of a reduction in that payment, so it helps us budgetarily this next year. And we think it's a good year to use that, take that opportunity because as you know, we're dealing with slight deficits.
Any other questions? Is there any public comments on this item? Okay. Seeing none, is there a motion? Yes, thank you. Is there a second? All those in favor say aye. Opposed and abstain? No one? Thank you very much. We are adjourned.